A Canadian senior can earn the same income as a neighbor and still pay thousands more in tax, simply because one person claimed the right credit, split pension income properly, and controlled taxable withdrawals, while the other person did not. In 2026, there is no single flat senior deduction that gives everyone the same result. Your savings depend on your net income, pension type, marital status, province, medical costs, and whether you are close to the old age security recovery tax line. In this video, you will see what the main federal savings can look like from about $30,000 to more than $100,000, and which steps may produce the biggest result. Start with the broad 2026 federal tax change. The lowest federal rate is 14% on the first $58,523 of taxable income. The federal government says this change can save an individual up to about $420 in 2026, or up to $840 for a two-income couple. This is built into the tax calculation. You do not submit a special senior application for it. But larger senior savings often come from credits and planning that are not automatic. The first number every Canadian aged 65 or older should check is the federal age amount. For 2026, the maximum age amount is $9,208. That does not mean you receive a check for that amount. It is a non-refundable tax credit. At the 14% federal credit rate, the maximum federal tax reduction is about $1,289, provided you owe enough tax to use it. Provincial or territorial age credits may add more. Here is the estimated federal saving at different net income levels. At $30,000, $40,000, or anything up to $46,432, the maximum saving is about $1,289. At $50,000, it is about $1,214. At $60,000, about $1,004. At $70,000, about $794. At $80,000, about $584. At $90,000, about $374. At $100,000, only about $164 remains. At approximately $107,819, the federal age amount disappears. The number that matters is net income on line 203600, not simply what reaches your bank account. RRIF withdrawals, employment income, taxable pensions, investment income, and other taxable amounts can increase that line. TFSA withdrawals do not count as taxable income. Before taking a large extra RRIF withdrawal near year-end, check whether it will reduce your age amount or trigger another tax cost. Next is the pension income amount. If you are 65 or older and receive qualifying pension or annuity income, you may claim up to $2,000 on line 31400. At the 2026 federal rate, that can reduce federal tax by up to about $280, plus possible provincial or territorial savings. The income type matters. Eligible RIF income generally qualifies after age 65, and many workplace pensions and annuities qualify. CPP, QPP, Old Age Security, and the Guaranteed Income Supplement do not qualify by themselves. In some cases, a person over 65 may convert part of an RRSP to a RRIF and withdraw at least $2,000 to create qualifying pension income, but never make a taxable withdrawal only to chase a $280 credit. The withdrawal may reduce GIS, shrink the age amount, or create OAS recovery tax. Use this strategy only when the withdrawal already fits your retirement plan. For couples, pension income splitting can be the largest saver in this video. You and your spouse or common law partner may jointly elect to allocate up to 50% of eligible pension income to the other person using Form T-1032. This changes the tax reporting. The pension payer does not have to redirect the monthly check. The goal is to move eligible income away from the higher income spouse and onto the lower income spouse's return. Consider a simplified federal example. One spouse has $80,000 of eligible pension income. The other has $20,000 of CPP, OAS, or other income that cannot be split this way. If $30,000 of eligible pension income is allocated, both returns show about $50,000. Under simplified 2026 federal calculations, including the basic personal amount, age amount, and pension income amount, the household's federal tax could fall by roughly $3,000 before provincial differences. The real result depends on the province, deductions, credits, and exact income sources, but this shows how a couple can legally save thousands through an official election. Do not automatically split 50%. The best percentage may be 10, 25, 40, or 50%, and it can change each year. Pension splitting may lower a tax bracket, restore part of the age amount, give the receiving spouse a pension income credit, and reduce OAS recovery tax. Tax software or a preparer should compare several percentages before filing. Lower-income seniors need a different strategy because a non-refundable credit cannot create a refund after federal tax reaches zero. If you owe little or no tax, the age amount, pension income amount, disability amount, or medical credit may not deliver the full advertised value. Filing is still essential because tax returns are used to calculate income-tested payments, including GIS and the GST or HST credit. For many lower-income seniors, protecting benefits is worth more than a non-refundable tax credit. At $30,000 of net income, the full age amount may be available. If you also have at least $2,000 of eligible pension income, the two federal credits could reduce tax by up to roughly $1,569, about $1,289 from the age amount, and $280 from the pension income amount. At $50,000, the combined maximum is near $1,494. At $60,000, about $1,284. At $70,000, about $1,074. At $80,000, about $864. At $90,000, about $654. At $100,000, about $444. These are estimated maximum federal reductions before provincial credits, and only apply if you owe enough tax to use them. Medical expenses are another commonly missed area. Eligible costs can include more than prescription receipts. Depending on the rules, dental work, private health plan premiums, hearing aids, mobility devices, certain medical travel, attendant care, and other costs may qualify. The federal credit is based on eligible expenses above the lesser of 3% of net income or the annual limit. Couples should compare both returns because the lower income spouse often has the smaller 3% threshold. Suppose a couple has $6,000 of eligible medical expenses and the claiming spouse has $30,000 of net income. 3% is $900, leaving about $5,100 for the federal credit calculation. At 14%, that is roughly $714 of federal tax relief, plus possible provincial savings. This is not automatic. Keep receipts, choose the best permitted 12-month period ending in the tax year, and compare both spouses. The disability tax credit can be larger. For 2026, the federal adult disability amount is $10,341, worth up to about $1,448 in federal tax reduction. Eligibility generally requires a severe and prolonged impairment that meets the legal test and certification by an approved medical practitioner. It is not granted simply because a person has a diagnosis. The application uses Form T-2201 and CRA makes the decision. An unused amount may sometimes be transferred to a supporting family member. If approval covers earlier years, past returns may also be adjusted, which is why some successful claims produce refunds worth several $1,000s. Home renovations can create another major saving. The federal home accessibility tax credit allows up to $20,000 of qualifying expenses for renovations that improve access, mobility, function, or safety for a qualifying senior or person eligible for the disability tax credit. At the 14% 2026 rate, the maximum federal reduction is about $2,800. Permanent changes such as ramps, grab bars, widened doorways, or safer access may qualify while ordinary repairs and movable items generally do not. Keep contracts, invoices, and proof of payment. Under the 2026 rules, the same expense cannot be claimed under both the medical expense credit and the home accessibility tax credit. Higher income seniors must watch the old age security recovery tax. For the 2026 income year, recovery begins when net world income exceeds $95,323. The repayment rate is 15% of income above that line until OAS is fully recovered. At $100,000 of net income, the excess is $4,677, producing about $702 of potential OAS recovery. At $110,000, the estimate is about $2,202. At $120,000, about $3,702. This comes on top of normal income tax. Do not refuse income only to protect OAS. Instead, control timing and income type where legally possible. A large RRIF withdrawal, capital gain, or sale in a non-registered account can push 1 year over the threshold. TFSA withdrawals do not count as taxable income. Pension splitting may move eligible income away from the spouse facing recovery tax. Legitimate deductions may also help. The mistake is waiting until tax season, after the income year has already ended. Here is your action checklist. First, find line 203600 on your latest return and estimate your 2026 net income. Second, if you are 65 or older, confirm the age amount on line 3100. Third, check whether your pension qualifies for the $2,000 amount on line 3400. Fourth, if you have a spouse and eligible pension income, Test several pension splitting percentages on Form T-2032. Fifth, combine medical receipts and compare which spouse should claim them. Sixth, consider a disability tax credit application, only if the official severe and prolonged test may be met. Seventh, keep every accessibility renovation invoice. Eighth, if income may exceed $95,323, estimate OAS recovery before taking extra taxable withdrawals. At lower incomes, the greatest value may come from filing every year and protecting benefits. Between roughly $30,000 and $60,000, the age and pension income amounts can meaningfully reduce tax. Between $60,000 and $100,000, pension splitting, medical claims, and withdrawal planning become more important. Above the OAS threshold, controlling taxable income may protect hundreds or thousands of dollars. These are not secret loopholes. They are legitimate parts of the Canadian tax system, but many are missed because nobody checks every decision for you. Review the numbers before December 31st, not after the year is over, and share this with a Canadian senior who may be paying more tax, simply because nobody showed them where to look.